Welcome back to Zak Wealth Files. I am Zak, and my entire mission here is to make investing, wealth building, and personal finance simple, accurate, and actually useful for your long-term goals. Today, we're looking at the anatomy of a hype cycle by demystifying the 2026 gold crash. We're going to dissect exactly what happened and, more importantly, why it happened. By the end of this explainer, you're going to walk away with a timeless, defensive investing framework that you can apply to protect your wealth when evaluating any hot asset, not just gold. All right, let's just dive right in. 28%. Just let that sink in for a second. That is exactly how much gold plunged from its wild peak of over $5,500 an ounce back in January 2026, dropping all the way back down near $4,000 by July. Look, anyone who bought at the absolute top, right when the excitement and the media hype were at their absolute loudest, is sitting on a very real, very painful paper loss right now. So how did this happen? And more importantly, how can you make sure you aren't the one caught holding the bag the next time an asset goes totally parabolic? You know, the fascinating truth here is that the initial buildup in 2025 and early 2026, it was absolutely not some manufactured, meme-driven rally. Not at all. It was actually driven by real, well-documented, structural macroeconomic forces. We were seeing a weakening US dollar and ongoing geopolitical tensions. We saw historically high government debt levels, raising some very valid questions about long-term currency stability. And maybe the biggest factor, we saw sustained, aggressive gold buying by central banks around the world who were just trying to diversify their reserves. I mean, China's central bank alone kept up a massive buying streak month after month for well over a year. So the point is, these were legitimate structural forces that fundamentally supported a price increase. But then we hit this absolutely wild data point. 84%. Investment demand from everyday retail investors. We're talking individual people buying gold bars, coins, and ETF shares. It surged a staggering 84% in a single year. That's the highest annual increase ever recorded. Which really begs the big question, right? If the underlying reasons for gold's rise were so real and structural, why did so many individual investors buy in at the exact wrong time, right at the local peak? The answer to that question actually lies in behavioral finance. It's a concept called recency bias. Basically, it's our psychological tendency to believe that an asset will just keep doing whatever it's been doing recently, simply because that's the most vivid information right in front of our faces. It is essentially momentum chasing. And honestly, it's completely human nature to feel that FOMO, that fear of missing out, when everyone around you seems to be making money. But think of it like this. It's like deciding to jump onto a speeding train solely because it's moving incredibly fast, while totally ignoring the fact that the tracks ahead are steep, winding, and completely uncertain. Because of this, a massive disconnect emerged in the market. On one side, you had institutions and central banks making these calculated purchases based on a structural story, long-term reserve diversification. But on the flip side, you had everyday retail investors reacting entirely to the price action. Actually, a survey taken right around the market's peak showed the vast majority of retail traders expected gold to just keep setting fresh records all throughout 2026. They were clustering their buying disproportionately at the very top, driven not by independent evaluation, but by media buzz and the simple fact that the price had already gone up. The reversal here was incredibly fast, and it perfectly maps out just how quickly a market can turn on you when you chase momentum. In January 2026, we hit that euphoric peak above $5,500. But by February, shifting geopolitical developments caused a meaningful retreat. We did see a partial recovery through the spring, with prices climbing back above $4,700 by mid-April on continued institutional demand. But then, late June and into July, the bottom just completely fell out, and gold dropped decisively below $4,000. So what caused that sudden drop? Ultimately, the fundamental macroeconomic conditions shifted. We started getting persistent inflation data, which pushed up expectations for even more Federal Reserve interest rate hikes, and that in turn led to a strengthening US dollar. Essentially, the exact fundamental conditions that originally fueled gold's historic rise effectively started moving in the complete opposite direction. That uncomfortable truth is that the structural long-term case for gold hasn't actually disappeared. The World Gold Council's own mid-year analysis clearly stated that central bank buying, elevated government debt levels, and reserve diversification, quote, haven't reversed. So the absolutely crucial point here is that this 28% crash was primarily about bad timing, momentum chasing, and hype. It was not about a fundamentally broken asset.
And right now, we are seeing genuine, documented disagreement among major financial institutions on what happens next. You have some credible experts forecasting continued weakness for the rest of the year. Meanwhile, several other major investment banks are forecasting a strong rebound, maybe even new record highs by year-end. If the professionals, the people who study global macroeconomics and commodity trends for a living, cannot agree on the near-term direction of this asset, that is a massive flashing signal that retail investors should absolutely not be trying to time the market.
Okay, here is the practical strategy you can take away and use this week. Step 1, separate the story from the price action. The underlying case for an asset can be completely valid, but that doesn't mean the current price makes sense. Always evaluate the fundamentals independently of how exciting the chart looks. Step 2, be incredibly cautious of media-heavy momentum. If an asset is dominating the headlines and all over your social feeds, behavioral finance tells us this is actually the highest risk point for buying near a local top. Step 3, use steady dollar-cost averaging. If you want exposure to an asset, build a modest allocation gradually over time. This completely removes that dangerous temptation to time a single perfect entry point. Step 4, view expert disagreement as a caution signal. When major banks publish widely varying forecasts for the exact same time frame, it means the near-term direction is genuinely uncertain. And Step 5, recognize that peak entry timing creates risk. A paper loss isn't always permanent, but future price movements are never guaranteed. Concentrating your buying based entirely on recent momentum is just a recipe for disappointment.
Now, I always want to be fully transparent with you guys. All investments carry real risk, including the risk of continued loss, and past price patterns do not predict future results. The insights in this explainer rely on publicly reported market data through July 2026. This is strictly general financial education, not personalized investment advice. If you're considering making any changes to your own portfolio, please consult a licensed financial advisor to make sure it aligns with your specific situation and your risk tolerance.
So here is the memorable takeaway I want you to keep in your back pocket. The underlying story that drives a genuine asset rally can remain completely valid, while the people who bought at the peak still end up deeply disappointed. Separating a valid story from peak hype is the true secret to long-term wealth building. If this explainer helped make a confusing market story finally make sense, hit that subscribe button for more wealth building clarity. And I want to hear from you down in the comments. Did you buy gold at any point this year? And if so, when? Thanks for hanging out, and I'll see you in the next explainer.